This morning, Mara Holdings opened like a completely different stock. By midday, it was up 9.3% on volume that dwarfed its 30-day average. The casual explanation is simple. Bitcoin moved, the miners followed. But that explanation misses everything that actually matters for your decision-making. Because if you understand the mechanics of why Mara doesn't just track Bitcoin, but systematically amplifies it, sometimes rationally, sometimes violently, you stop reacting to these moves and start anticipating them. So the real question is not what happened today. It's whether this move has legs, or whether you're watching the last buyer get in. Let's establish the facts before we build any narrative around them. As of July 20th, 2026, Mara Holdings moved 9.3% on volume that ran approximately 2 to 3 times its trailing 30-day average. When you see that combination, price surge plus volume surge, you're not looking at retail chasing a ticker. You're looking at institutional repositioning. The proximate catalyst here is layered. Bitcoin itself was up meaningfully in the session, clearing a key psychological and technical level that quantitative desks had been watching. When Bitcoin breaks a resistance level with conviction, the options market in miners like Mara reprices almost instantly. Delta hedging by market makers creates mechanical buying pressure in the underlying shares. And that force is independent of any fundamental thesis. It's pure plumbing. But there's a second layer. Mara has been aggressively expanding its hash rate capacity throughout 2026, and recent operational updates suggested their energy cost per coin mined is trending toward the lower end of the industry range. In a Bitcoin bull environment, that cost structure becomes a multiplier on gross margin. Investors aren't just buying Bitcoin exposure. They're buying operating leverage. Here's the actionable piece for you. Before you chase any miner stock on a day like this, identify whether the volume is front-running an options expiry, responding to a Bitcoin technical break, or reacting to company-specific news. Each of those scenarios has a very different expected follow-through. One is mechanical and fades. One can sustain for days. One is potentially a re-rating event. Conflating all three is how retail traders consistently buy the exact top of these moves. Here's the concept that separates people who understand Bitcoin equities from people who just watch the ticker. Mara is not a spot Bitcoin ETF. It is an operating company with fixed costs, debt obligations, capital expenditure commitments, and energy contracts. And that cost structure creates something that no ETF can replicate: operating leverage. The math is straightforward. If Mara's all-in cost to mine one Bitcoin, accounting for energy, infrastructure, and overhead, sits around $40,000 in this environment, and Bitcoin is trading at $90,000, the gross profit per coin is roughly $50,000. Now imagine Bitcoin moves 10% higher to $99,000. Your revenue per coin just jumped 10%, but your costs stayed fixed. Gross profit per coin goes from $50,000 to $59,000, an 18% increase in profit from a 10% move in the underlying asset. That is the lever. The stock doesn't move 10% when Bitcoin moves 10%. It moves more, sometimes significantly more, because the equity market is pricing changes in expected profitability, not just changes in asset price. Today's 9.3% move on a moderate Bitcoin session is consistent with this dynamic. Mara's beta to Bitcoin has historically ranged between 1.5 and 3, depending on market conditions, debt levels, and where Bitcoin is relative to the cost of production. In a high Bitcoin environment, the beta compresses. In a low Bitcoin environment, the beta expands and becomes devastating on the downside. This is the part beginners miss entirely. The same lever that produces a 9% day can produce a 15% loss day when Bitcoin pulls back 5%. This is not financial advice. Miners are genuinely high-risk instruments, and they should be sized accordingly in any portfolio. The volatility is the product, not a side effect. This is the question that actually determines whether today's action is a signal or just noise. And to answer it, you need to look at 3 things: Mara's balance sheet, its forward hash rate trajectory, and how the current Bitcoin price translates into expected earnings power. On the balance sheet, Mara has been one of the more aggressive accumulators of Bitcoin among publicly traded miners. They hold a significant portion of mined coins, rather than immediately liquidating. A strategy that amplifies gains when Bitcoin runs, but also creates concentration risk that doesn't show up cleanly in traditional valuation metrics. If you're using price-to-earnings multiples to evaluate Mara, you're using the wrong lens. You need to think in terms of enterprise value relative to hash rate, estimated annual coin production, and the net asset value of their Bitcoin holdings, marked to current market. On hash rate expansion, Mara has publicly committed to aggressive capacity growth in 2026. More hash rate means more coins mined, but it also means more capital expenditure and more energy consumption. If you're modeling Mara's forward earnings, the key assumption isn't the Bitcoin price in isolation. It's the Bitcoin price relative to network difficulty, which rises as more miners come online globally. More competition compresses margins for everyone, even as Bitcoin's price rises. So, is today's 9.3% move justified? Partially. The operating leverage math supports a meaningful equity reaction to Bitcoin's move. The balance sheet concentration adds upside torque, but the momentum component, the gamma squeeze from options, the volume surge from retail FOMO, that part is typically not sustainable beyond 1 to 3 sessions without fresh fundamental catalysts. What you want to watch in the next 48 hours. Does volume normalize while price holds, or does price give back half the move on declining volume? The first scenario suggests institutional accumulation. The second confirms the move was largely mechanical. That distinction is worth more than any price target you'll read in a research note. We opened by asking whether today's 9.3% move has legs, or whether you're watching the last buyer get in. The honest answer is, it depends on which component of this move you're evaluating. The operating leverage is real. The momentum is temporary. The risk is always larger than it looks on a green day. Now here's the question we haven't answered yet. What happens to miners like Mara when Bitcoin's network difficulty outpaces its price appreciation? And which miners survive that scenario? That's the next video. Subscribe so you don't miss it.